Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly economic review for the week ending December 16, 2022. Please note that this is the second to last review of 2022. Next week will be the last, and it's going to be on Thursday, December 22nd, because on the 23rd it's a holiday here at IA Financial Group, and there won't be a review during the holiday period. So this is the second to last one of the year. So a look at this week's markets at the close on Thursday. So positive for bonds, negative for equities after 4 days. Market tone has shifted dramatically, let's say, this week. Let's see if there's a new trend here. We'll discuss that in a few minutes. But positive for bonds, negative equities, positive for oil, Canadian dollar lower because the USD was very strong on Thursday. So as a safe haven bet, euro up, gold down. So lots of volatility again as we are about to close the year. So the topic of the week, the Federal Reserve. Last week we did a deep dive in the Bank of Canada. Now we'll do the same thing with the Fed, but the Fed is very important for the markets. So we'll also look at the markets, by the way. On purpose, I didn't bring a chart about inflation, but inflation in the US was softer than expected. The report for November came out on Tuesday. There was some optimism about it on Monday during the trading day, and on Tuesday also when the number came out. But then on Wednesday, Mr. Powell came in and the Fed and said, well, there are more hikes to come in 2023, and the fact that inflation was easier, that doesn't change their view at all. So volatility during the afternoon on Wednesday during the press conference, but a very strong shift of tone on Thursday, and on Friday morning, as I'm recording this again, markets are not open. We're looking at another negative day here. So the market was starting to think that rate hikes are about to end, and then there will be cuts in late 2023. And this is the crux, this is the important part. The Fed is pushing back strongly against that, and this could lead to market adjustments. So now we're at 4.5% on the leading rate. Where will we go in 2023? Well, the market is pricing, as you can see in this chart here, is pricing in that we will have 2 more hikes of 25 basis points by June. So the market is thinking that, well, the very coming months in early 2023, we'll have 2 more hikes, whether it's 25, 1 times 50, it's still up in the air, but the market is thinking 25 early in the year and then another 25, bringing us to 5%, and then likely that's it. So this is what the market is thinking. And when we move to the next slide here, this is also the signal from what we call the terminal rate. So we look at all of the contracts in 2023 and see what's the highest pricing. And the market is thinking the highest will go is 4.89%. So let's round it up to 5%. So market is there. Interestingly, the blue line, which is what I just described, is above the red one, which is for Canada. So the Fed should hike more than the Bank of Canada. And on the bottom, you see the gray line. This is the European Central Bank, the ECB. And as you can see, they're starting to see some adjustment higher here because of the hawkishness of the ECB in their decision on a Thursday. But maybe that's a topic for another time. But if we move to the right, this is the important part of the message here. Projections from the Fed is that the rate will be at 5.1% at the end of 2023. So no rate cuts in the second half of the year. This is important. And here what you have, this is the dot plot. I've shown that a few times, multiple times through the years, maybe not recently, but every member of the FOMC committee, the committee that decides monetary policy in the US, there's 19 members, and they get to place their little forecast when they go into the meeting here, and they publish it in this format here. So the median of the FOMC members is thinking that 5.1% by the end of the year. But if you look, there are 7 dots that are above median, 7 out of 19. So if there's some risk to this forecast, the risk is that rates will be even higher than 5.1%. So this is the pushback that the Fed is giving the markets. Markets are thinking, all right, we're almost at the end. 2 more hikes will be at about 5%, and that's it. And then they can start to ease. Fed is saying not so fast. If we ease, it's not in 2023, it's going to be in 2024. Markets are forward looking. So this is what's impacting the markets now, and this is what's causing this adjustment in the market. And talking about adjustments, here maybe a market action on Wall Street. 2 charts. On the left, you have 2022 for the S&P 500. So this is the price of the S&P 500 all year. As you can see, we were in bear market rally number 6. At least we're still in it until we cut through the lows of October. But all of those numbers here are just, counting the bear market rallies. Bear market rallies, they last for a while. They're normal. When you're deep in the bear market, they get stronger. But usually, on a historical basis, let's say the median and the average pretty much in line between 8 and 10 bear market rallies before we're done. So it's not a law of physics. That doesn't mean that we need to have 8 or 10 to be done, but bear market rally number 6 here could be under pressure because of this market adjustment, repricing, maybe fading optimism. So that's an important one. And on the right, technical analysis here. We don't manage using technical analysis, but we look at everything, including technical analysis, because we know it has some importance because of all of the, let's say, hedge funds in the world that manage according to that. And we were at a resistance and we failed to pierce the resistance. And now we're pulling back from resistance with some conviction because of a change in the story. So, the technician could say that, well, maybe we could prepare for, retesting the lows here. So this is our base case. We think we will be retesting the lows. Will it be quick? Will it be slow? It's always hard to tell, but we think that we might not be done with this bear market here. And we remain positioned defensively in our managed funds at iA Financial Group. Looking at the interest rates now, on the left you have the 2-year rates, on the right you have the 10-year rates. Let's start on the left. If the Fed is convincing the markets that it will go above 5% and it will stay there longer, maybe we could see some pressure upwards on the 2-year rate still over the coming weeks and months, and that would mean a tightening of liquidity and financial conditions. So that could be a headwind for market sentiment and for equities. On the right, the 10-year rate, well, 10 years is a long horizon, so it looks at monetary policy in the short run, also the success in fighting inflation, risks of recession next year. So it's hard to tell, but we're thinking that maybe we'll stay between where we are right now and the recent peak, maybe for the coming weeks and months. At least this is our hunch here, and we're positioned a bit more neutral right now on duration in our funds. So what to watch next week? In Canada, we'll have retail sales, CPI inflation, always an important number, and GDP growth for October. And in the US, we'll have the revision to Q3 GDP, about 3%, personal income, personal spending, and the always very important sentiment index from the University of Michigan. So that wraps it up for the week. ia.ca/economy. If you haven't done so, you can subscribe to the newsletter on the webpage. In Your Interest podcast, we just recorded 2 recap of 2022 episodes with my friend and colleague Marc Gagnon. So first episode is already out. Second one will be out next week. And in early 23, we already recorded an outlook on 2023, again with my colleague Marc Gagnon. So some good stuff there. I encourage you to give it a look. Economy Finance 101, I've been saying that for a while, but there is some new material that's just about to be published, so stay tuned. And social media, Twitter and LinkedIn as always. So thanks for following us, and I'll be back again next week.